Hey there, welcome to Crypto10 Digest. I'm Mike, and I'm gonna be your guide in today's video. Now, this is our very first video, and I'm not gonna jump straight into the news just yet. Instead, I want to talk about something way more important: the core mindset you need to succeed in investing. Whether you're a solo investor or a pro, this is the number one thing you gotta get right. But before we dive into the main part of the video, I just want to ask you, take a moment, and really pay attention to what I'm about to share. Don't just hear it, listen closely. Because this video, it's for everyone who's already in, just getting started, or thinking about entering the financial market. It's the kind of video you'll want to watch again and again, especially when things get tough, when you feel lost, disappointed, or unsure about your next move. And hey, even if you've got a full-time job and you treat investing as a side hustle to build your wealth, then you especially need to watch this with focus and respect. I promise you this video right here, it might just change your life. It could completely flip your whole perspective on investing, and honestly, it could help you make millions of dollars, real money, straight up cash. Alright, first, let me show you why investing really matters. Actually matters. Because here's the truth: if you're not investing, you're already falling behind. Just saving money? Well, sorry, that's not enough anymore. See, money that just sits there, it loses value every single day. Meanwhile, other people's assets, they're growing, minute by minute, thanks to investing. Alright, let me keep going, and prove to you everything I just said. Not with hype, but with real, solid facts. Because once you see it for yourself, you won't ever look at money the same way again. What a dollar could buy 50 years ago, now takes 10. That's inflation, at work. And the crazy part? It's not slowing down. Prices just keep going up, quietly, relentlessly. Your cash in the bank? It's losing power, every day. Even if the number stays the same, what it can buy gets smaller and smaller. Let's say inflation eats up 90% of your money's value over the next 50 years. Yeah, 90%, gone. Now, if you want to just maintain your money's value, not grow it, just keep it from shrinking, then your average bank return, after tax and inflation, needs to hit at least 4.5% a year with compound interest. If you're getting less than that, you're losing money. Slowly, quietly, every single year. Even if you think you're saving. That's why just saving isn't enough anymore. You need a plan, a way to grow your money faster than inflation. And that's where investing comes in. Not a maybe, a must. Rich people don't have 25 hours in a day. They've got something better. They use leverage, like investing, and compound interest. Here's a living example of what compound interest, and a little patience, can do. He started investing at age 15. By 30, he had $1 million. By 60, he crossed the 1 billion mark. It's not cause he was smarter than you. It's cause he was more patient than you. Real story: US housing market. Back in 2019, priced at $615,000. By 2022, it jumped to $900,000. Someone who just saved cash, they held on to the same dollars. But someone who invested, their assets grew, big time. So tell me, who really lost money here? Let's break it down. Who really owns America's wealth? The top 0.1%? They control $22.39 trillion. That's 12.4% of the nation's wealth. The top 1%? They hold $27.91 trillion, about 15.5% of all wealth. The top 9% after that? They control $62.23 trillion, a whopping 34.6%. The next 40% of the population? They own $57.14 trillion, about 31.8%. And the bottom 50%? They have just $9.97 trillion, only 5.5% of the wealth. Now listen, just the top 10% alone own over 62.5% of America's total wealth. That's not a small gap. That's a chasm. One more thing to keep in mind: these numbers? They're only the reported, estimated assets. The real gap? It might be even bigger than we think. Wealth is concentrating, fast. The rich? They let their money work for them, every single day. The rich? They just keep getting richer. Why? Because their money never stops working. This is proof: in just 4 years, they doubled their wealth. Now the real question is, what about you? Every time there's an economic crisis, I mark it with a red arrow. And every time interest rates drop, the government pumps massive money into the markets, trying to keep things afloat. But it weakens the dollar's buying power. Since leaving the gold standard, the US dollar has kept losing value. And the national debt? It keeps growing, with the debt ceiling raised again and again. History is clear: collision investing always wins. Yeah, we've had crashes. I marked them with those red arrows. 2000, 2008, 2020. But after each one, assets like stocks, real estate, even Bitcoin, they bounced back and soared. Look at the big picture, the Dow Jones, the S&P 500. They always trend upward over time. Zoom out far enough, and those crashes, they're just tiny bumps on the road. New generations of investors, they barely even feel the impact. The ones who stay invested, who don't quit, they're the ones who win. If you don't invest, life might still be okay, but you'll always be chasing the rising cost of living. You'll miss the chance to build real wealth. You'll spend your whole life working for money, while others let their money work for them. Remember this, the winner isn't the smartest one. It's the one who stayed in the game and kept building wealth the longest. The choice is yours. Bullseye investing isn't optional. Right pointing arrow, it's a must if you want financial freedom. So what do you choose? Check mark to be the one who holds the assets. Cross mark or the one left out of the game? Well, if you've decided to invest, then stick around and keep watching, alright? And hey, if you find this helpful, don't forget to hit that subscribe button and like this video. Now, let's dive in and uncover some real secrets to building serious wealth through investing. Before you invest, you need to answer two questions. First, in the long run, do you believe the financial markets will go up or down? Second, who really decides the direction of the market? Is it you, or the ones who built the game? So the first question is this. If we look at the long-term view, like I said earlier, the evidence is clear. Over time, financial markets, stocks, bonds, gold, and even newer assets like crypto, they tend to go up. And they often grow way faster than what you'd ever earn from just saving money in a bank. Alright, question number 2. Who really drives the market trend? Is it the market makers or small, individual investors? See, retail investors, they tend to trade emotionally. They react to the news, buy and sell frequently. And most of the time, they don't hold assets long-term. Sometimes they even borrow money to invest, which often leads to market drops. So yeah, the real influence comes from the market makers. Who are they? Big investment funds, central banks, billionaires, major corporations, and of course, governments. Different players, but all part of the same game. And in this game, there are rules. Even market makers have to play under the law. Governments lead with policy, others lead with money, and a whole lot of it. Why do governments step in to guide the markets? What's really in it for them? And if they didn't, what would actually happen? Let's keep going. Mike's gonna walk you through it. To make things simple, I'll answer this with a bigger question. Why does finance even exist? What's it really for? I'll share my personal take on it, and from there, the answer will start to make sense. Alright, here's something important. Mike's got a triangle chart for you. And there are 3 sides we need to pay attention to. First, the economy. Second, society. And third, the one we're all here for, the financial market. So what's the role of each side of this triangle? Why are they all connected, like a circle that feeds itself? Let's break it down. First, the economy. Its job is to produce, to offer services, to trade, to create jobs, to generate income for people. The economy puts food on the table, clothes on our backs, and builds the foundation of public services, like education and healthcare. In every country, the economy exists to sustain daily life. Next, society. Society provides the human resources, both physical labor and intellectual power, to keep the economy running. People work, earn income, and once their basic needs are met, they start aiming higher, to build wealth. That's human nature. It's right there in Maslow's hierarchy. Now, here comes the financial market, the part we're all focused on. When people have extra money, they want a place to put it, to protect its value, or make it grow. That place is the market. Stocks, bonds, crypto, you name it. And here's the key. Money invested into the market flows back into the economy. That money helps businesses grow. It's used to upgrade technology, expand production, create new jobs, and build better products and services. So in short, the financial market recycles capital back into the economy to serve society. That's its essential role. That's why it exists. Now think about this. If one part of that triangle breaks, everything else suffers. If the market crashes long-term, capital dries up. No more business investment, no job creation, no income, social stability falls apart. So let me ask you this. Would the market makers go out of their way to let the entire system fall? Of course not. That's why, in the long run, financial assets always grow. Hey, if you've made it this far, that's awesome. Thanks for sticking with me. If you've got thoughts or ideas of your own, drop a comment down below. I'd love to hear what you think, so we can keep this conversation going. Like I said earlier, 50% of the population holds just 5.5% of total wealth. So ask yourself, can the majority really drive market trends? when they control so little of the actual assets? Most of them lack real knowledge, they don't have much experience, and honestly, they're just reacting emotionally. They buy and sell based on headlines, on what others say, without any personal conviction or clear strategy. So when people like that debate each other, do they actually lead the market? Or are they just noise in the system? So, what's the real strategy here? How do you actually win in this complex, emotional, and fast-moving financial world? Well, here's the truth. It's not about predicting the market. It's not about being the smartest. And it's definitely not about chasing quick gains. Success comes from doing what most people won't. Right pointing arrow having patience. Right pointing arrow sticking to your plan. Right pointing arrow building conviction through knowledge. Right pointing arrow and letting time and compound growth do the heavy lifting. You don't need to be perfect. You just need to stay in the game long enough. Every game has its rules. And the financial market, where we play the game of investing to grow our wealth, is no exception. If you don't know the rules, then you're not really playing the game of investing. You're just guessing, and honestly, your odds of winning in the end? Pretty low. Alright, to make it more real, let me share a few rules that I personally believe in. These aren't just theories, they come from real experience, from years of being in this market. So, let's get into it. Following the rules isn't easy. I get it, but it's not optional, it's something you have to do. Because if you act on emotion, on greed or fear, the market will punish you. Every single time. The rules of this game? Yeah, most people actually know them. But here's the truth, very few actually follow them when it comes to investing. Why? Because emotions always get in the way. I've put everything together, right here on the screen. Feel free to pause and take a quick screenshot, so you can save it for later. It's not a hard game, but it's not easy either. The real challenge is sticking to the rules. That's what separates winners from everyone else. A lot of people, especially those who've never actually invested, they think these rules sound cliché, or just plain useless. But here's the twist, almost no one follows them. And the ones who do, they're the ones who win. Have you ever heard these two rules? Rule number 1, never lose money. Rule number 2, never forget rule number 1. That quote? Yeah, it's one of Warren Buffett's most famous rules. It highlights one key thing: before chasing profits, you've got to protect your capital. Because if you lose your base, there's nothing left to grow. Investing is already stressful enough. If you're borrowing money, you simply can't invest for the long term. You'll end up just day trading, trying to ride the waves. And honestly, that's not for amateurs, it takes tons of experience. If you're new and want to try it out with a small amount, sure, go ahead. But in the long run, it won't really help you. When you invest a big amount, doubling or tripling your money, that's already a lot of cash. But with a small amount, you gotta be patient, adding bit by bit, week by week, month by month. It's like nurturing your financial tree, watching it grow until it finally bears fruit. And when that happens, you won't have to stress about money anymore. When the cash flow from your investments can cover your basic needs for you and your family. That's a big milestone. Now, the number? It's different for everyone, because each person's lifestyle is unique. To succeed in investing, one thing's super important. You have to invest in the right assets. It's not like, just invest in anything and you'll win. Nope, you need knowledge, and you've got to think like a big investor. That means choosing things like index funds, companies with solid history, or long-term trends. Or yeah, maybe Bitcoin, but not some random altcoin with no track record and tiny market cap. It feels safer to buy real estate, right? But what if you don't even know what you really need? You might skip the research and forget to check key metrics like demand, location, legal status, or building quality. And without those, you could easily run into big issues, bad structure, poor surroundings, or worse, legal or zoning problems. If you're borrowing money and you don't have a long-term vision, then guess what? You won't be able to wait for the asset to actually explode in value. But if you invest with idle cash, study what you're buying, and hold it long-term, maybe 10 years or more, then hey, congrats, you're in a position to watch your portfolio 2x, 3x, even 10x over time. Depends on your risk appetite and how big you're aiming to win. Now, to actually see your portfolio grow that much, you'll need real strategies, like actionable ones. So far, I've mostly talked about mindset and how I personally see investing. But yeah, I haven't gone into specific buy-sell tactics yet. There are a few practical strategies I'll be sharing with you in upcoming videos. Stay tuned. Right now, there's one super important rule we need to follow. Don't put all your eggs in one basket. Yeah, you've probably heard it 1,000 times. But what does it really mean? It means, spread your risk. Because worst-case scenarios, black swan events, wars, natural disasters, pandemics, they don't come with a warning. And when they hit, you better be ready. Let's be honest, you can't always see risk coming. And sometimes, you're just not in the best position to prepare. So what should you do? Start simple, but always set aside something liquid. It could be cash, Bitcoin, or anything you can quickly convert into essentials or local currency, anytime. Not because you're scared, but because you're smart. When you're investing, always keep some cash on the side, based on your capital and portfolio size. Why? Because big opportunities don't wait. When the market drops, or a valuable asset gets cheap, you need to be ready. And that's when a classic rule comes into play. Be greedy when others are fearful, and fearful when others are greedy. Simple, but powerful. Okay, so to really apply this rule well, you'll need to understand a bit of technical analysis. Why? Because it helps you see the accumulation phase, when the crowd is scared, but the whales are quietly buying in. And it helps you spot the distribution phase, when the crowd is hyped and greedy, and the whales? Yeah, they're cashing out. That's when you need to follow the whales, not the crowd. Remember, the whales' two biggest weapons are fear and greed. And they know exactly how to use them against emotional investors. When Warren Buffett was interviewed, a reporter asked him, "With your wealth and success today, your method seems surprisingly simple. Anyone could do it, so why doesn't everyone become rich?" And Buffett replied, "Because no one wants to get rich slowly." That's it, and that's also our fifth principle. Patience. Because getting rich slowly is how real wealth is built. You need to let your capital work. It takes time. Let compound interest, the eighth wonder of the world, work for you. Let time be your ally, not your enemy. Warren Buffett started learning and investing when he was just 15. But guess what? He didn't hit his first million until he was over 30. And he didn't reach his first billion until his 50s or 60s. Yeah, it took him 15 years to make that first million. But the next 45 years? He turned it into a billion, all thanks to long-term vision and compound growth. It's like a snowball, the longer it rolls, the bigger it gets. That's how he built massive wealth. And the crazy part? His lifetime average return was just around 20% per year, not 200%, not 2000%. So think about it, you're new to investing, maybe no real experience, no deep knowledge yet, and you expect to get rich overnight? You're setting yourself up to lose. This market, it's brutal, 9 out of 10 people lose, so that one winner can exist. So in the beginning, focus on learning. Build your strategy, train your emotions. Once your mindset is solid, success in investing? It's just a matter of time. Start small, seriously, just start. Use a small amount of money, just enough to feel it, but not enough to lose sleep over it. This is about learning, about building your mindset, before you go big. As of July 2025, Warren Buffett's estimated net worth is right finger $128 billion, according to Forbes and the Bloomberg Billionaires Index. And get this, he's already donated over half of that wealth to charity, mostly to the Bill and Melinda Gates Foundation and other causes. Yet, he's still in the top 5 richest people on Earth. Here's what's even more surprising. Most of that wealth? It came after he turned 50. Yeah, let that sink in. Let's be honest, most people enter the market because of greed. But guess what? It's that same greed that causes them to fail. Investing isn't gambling, it's not luck, it's a game with rules. And the winner is the one who follows those rules with discipline. In the long run, discipline beats intelligence. Yeah, really, it's not the smartest investor who wins, it's the one who shows up, follows the plan, and stays in the game when others panic and quit. Discipline is the most underrated, yet most powerful edge you can have in this game. So, how do you build discipline? Well, start with the little things. Set a rule and stick to it, even when emotions run high. Like, only invest money I don't need in the short term. Or, never panic sell when I've bought the right asset. Write it down, read it whenever you feel shaky. Repeat it, until it becomes second nature. You don't have to be perfect. Just stay consistent. The financial market, by nature, always grows in the long run. The winners aren't the smartest. They're the most persistent. Knowledge, mindset, and discipline. That's the formula for building wealth that's big, steady, and long-lasting. If this video gave you value, go ahead and like, subscribe, it really helps. So, what are you investing in right now? Drop a comment, I'll reply to everyone. In the next video, I'll go deeper into the strategies I personally use, when to buy, when to sell, and when to just hold tight. Plus, I'll share the real-life methods I'm using to earn the money I invest. So yeah, don't miss it. Hey, just a quick reminder. Legally speaking, Mike is not your financial advisor. Everything I'm sharing here is for educational purposes only, not financial advice. So please, do your own research, double check the facts, and take full responsibility for your choices, alright?